process is a semi-annual process that we do in May and in November. It's a bottom-up reassessment of the entire equity universe where we screen for applied exponential technologies and how they show up in terms of revenue generation for companies. There are some usual suspects that have remained at the top, such as NVIDIA, Alphabet, and also Apple. But we do have some new entrants in the top 20 and also in general in the portfolio. Two names that I would mention are Visa and MasterCard. They play a key role in the ecosystem of payments and have a very interesting position in that ecosystem in terms of being in the focal point of this hub and spoke system. And they continue to innovate and apply technology as the system evolves, as payments and behaviors and trends evolve. And they have a very strong infrastructure to capitalize on future developments. Some new names in the portfolio that are notable are Illumina and ASML Holding. Illumina, you probably have heard of, is the global leader in next generation genome sequencing. That becomes quite a significant position in the index. And ASML Holding designs computer chips and interestingly applies 3D printing and additive manufacturing in their design of complex shapes for integrated circuits. So overall, looking top down, there haven't been major shifts. So we continue to see big data as our biggest sector, which is around 22% in the rebalanced index. And that is followed by Internet of Things and artificial intelligence, which are both around 17%. There weren't huge shifts in terms of the weight changes. So big data grew by about 2 to 3%. Internet of Things also grew by about 2%. The largest gainer in terms of sector was 3D printing, which gained by roughly 4 percentage points. And by the same amount, by 4%, our space sector was reduced. And that is mainly because of a number of firms that have been eliminated from our universe due to our ESG filter. The index has a very attractive profile in terms of profitability and growth compared to the MSCI world. Also, in terms of the indebtedness of our companies, that is significantly lower, and the liquidity ratios are also better. And all of this doesn't come for free, naturally, but it comes at a reasonable valuation. For instance, the operating margin of our portfolio is 15%, which compares to roughly 10% for the MSCI world. The net debt to EBITDA is half of the level of the MSCI, and the current ratio in the portfolio is about double that of the MSCI. And all of that comes at a valuation of roughly 18 EV to EBITDA, compared to 12 for the MSCI world. Yeah, in general, we're pleased to see that there has been a steady outperformance year to date of the MSCI world. We have outperformed the index on the downside into the correction, but also have fared well on the upside, which is good to see. And I would highlight that it is both a combination of positive stock selection through our investment methodology, but also we do have a bit of a stronger tilt to tech and healthcare, which have fared relatively better year to date. Fund performance was positive. We gained about 5 to 5.5%. That is an outperformance of roughly 1% versus the MSCI World. So it's good to see that after a very strong April, we have continued on a strong path in